Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the WorryFree Retirement with Tony Walker. And now, the host of the WorryFree Retirement, John Ramsey.
Yes, indeed, and welcome to the WorryFree Retirement, the only show in the country dedicated to helping savers like you and I worry less about their money. With us right now is none other than the author and creator himself, Senior Market Advisor Magazine's finalist for Advisor of the Year. Here he is, Tony Walker. Tony, welcome back. Another show here, but before we get started, I have to know, because you always have exciting weekends to talk about. Let's talk about your weekend.
Well, first of all, I missed you last week. Where did you go?
I had bought a little condo for the weekend through a charitable cause. Okay. And went down to South Beach and enjoyed that with my family. Had a good time.
Jill and the boys?
Yes, sir.
Wow.
Yes, sir. Mm-hmm.
Any marshmallows on the beach?
I knew you were going to ask that, okay. but no, I did pass on the marshmallows.
I thought you folled my advice on everything, John.
I do financially. I do.
Okay. I got another marshmallow story. Can I get into that before we start our show? I mean, I don't know if folks heard this the last time. A couple weeks ago, you know, the last of the romantics, I had my little lake cabin with my wife. We cooked some marshmallows celebrating our anniversary. I always cook the marshmallows. I know how to cook marshmallows. I don't know this what you do, John. It's not like a steak well done. I mean, you don't burn a marshmallow. You get them down there by the coals, turn it frequently.
I like them brown, yeah.
A little brown, little smoke coming up, but not much, and voila, perfect. Well, my wife, she decided she's going to cook her own marshmallows, so we got our son this time up here, our oldest, a friend of his, my wife, and you remember the big frog gigging thing we used to cook them with? So there she is, and she sets it right in the fire, and I'm just shaking my head thinking, Susan, that's not how you do it. I know what I'm doing. Man, all of a sudden, poof, the thing just flames up. She takes it out, John. I don't know if you've seen the movie Dennis the Menace where he flings it and it hits Mr. Wilson, but she's waving this thing. Looks like Darth Vader waving it, trying to put it out. Yeah, we're backing up. It was crazy. But I thought about it. I said, okay, there's got to be an analogy for this for finance.
Here he goes.
I'm thinking, okay, the consumer out there trying to mess with the stock market, all right, doesn't really understand the market, sometimes burns the marshmallows. And then they panic, and then they pull the marshmallows out and then dangerously flings them around. So what I remind people of, you know, messing with the stock market's kind of like cooking with marshmallows. You got to know what you're doing, and you can get burned. So be careful out there, because we're going to talk a lot about what's going on in the market today and what we're seeing with articles. This is really interesting, what we're seeing with Wall Street and that type of thing. It's really interesting right now.
Not only is he a financial expert, he's also a marshmallow expert, so now we know the tie-in. Let's talk about that a little bit. Before the show, you and I were discussing an article, and it talked about the impact of 9/11, and I think everyone would agree that impacted us all in this country as a whole. But also, the stock market crash of 2008 impacted this country as well financially and us individually. And we were discussing kind of the fallout of that, how it's changed people's behavior.
9/11 really changed my philosophy, John. I was in a money management practice back then. I had my own practice. I did a lot of annuities and things, but mainly I was focusing on managing money. They flew into those Twin Towers. I think that fundamentally changed the country in a lot of ways. I think we'd all agree with that. But then 07 comes along, roaring back. Remember how well the market was doing? The Dow was up around 14,000. Market takes a huge correction. I think what we're finding out, that correction was actually more severe than what happened in 9/11. I don't know if we can put it full screen. I want to give kudos to this particular article. This came out of Psychological Scarring. 5 years after financial crisis, many families hoard cash. This is an AP article that came out recently in just our normal pages. Here's what they say. I'm going to quote a lot out of this article because this is really important, but here's what they say. The implications are huge. This is the people talking about what's going on with what I call Joe Lunchbox, what I refer to as you and me, the savers of the world who really drive this economy, quite frankly. The implications are huge. They're shunning debt and spending less. This can be good for one's family finances, okay? But when hundreds of millions do it together, it can starve the global economy. All right, thank you. Now, what do you make of that statement as you sit there and look at that? Because obviously, these are people writing this article who are concerned our economy is not roaring back, and they're almost kind of blaming what I would call savers for, quote, hoarding cash?
I think what it seems to me, and I want you to confirm this, that savers have learned a lesson. They're watching this, and instead of being, they're being encouraged by all the media, all these so-called experts are saying, jump back in, we get your money back in the market, now's the time. And they're going, no, wait a minute, I've been burned once. You're not going to burn me with that marshmallow twice. I'm going to be careful. So I think now they're saying, savers are saying, look, I'm going to hold on to this. You're not going to convince me it's okay, because I think they've learned their lesson. Correct?
I agree. A gentleman from ING who is quoted in this, from the investment world, I like to call from Wally World, says the attitude toward risk, this is a great quote, he's correct, the attitude toward risk is permanently reset. So what I've been trying to preach for years, folks, is especially with the WorryFree Retirement, this philosophy that was born out after 9/11 when I decided that I didn't want to put my clients' money at risk either. We have a little bit of money in the market for our clients, but mainly savers don't want a lot of money in the market. And I think this quote is really helps understand the WorryFree Retirement. I believe that. I believe savers have reset their risk, and what they're saying is, wait a minute, I don't want all that risk. I never wanted to be in that world. That's just where I was told to be. I followed the herd and went right in there, and I'm not going back in that world. So as much as people in these articles can talk about people need to get back in the market and you're not earning enough money, see, it's a scare tactic. What I'm saying is be careful. Go with your gut on this. If you're a saver, stay with your gut on this. Invest in safe products. We're going to talk in a minute about fixed annuities, why these fixed annuities are getting very, very popular. We've created a website called the 3 Personalities of Money, John. If somebody says, I don't know if I'm a saver, I don't know if I'm an investor or speculator, Tony, help me out. I've created a non-biased 5-minute quiz. You can log on to 3personalities.com and take this non-biased quiz, and it'll help you determine, John, your predominant financial personality, whether you're a saver, investor, or speculator. Now, before we go into the break, by the way, I touched on annuities just a little bit. Many of you out there may have purchased variable annuities back when the market was doing well. Back when the market was doing real well, remember, variable annuities tied to the stock market. Some of these insurance companies issuing these are getting a little nervous, John, because they issued something called income riders. These income riders pay a very high rate of return. They're still being offered by contracts, but the variable annuities have had to lower their rates, and it's interesting, they're wanting to buy back these annuities. So folks, if you've got an older variable annuity contract, in fact, we've got one here mentioned in the article. If we can, let's put that up. This is an example, John. This is referring to the AXA. This is a variable annuity. It's called the accumulator product. And it was issued, if you have a contract, here's the thing, you might want to drag out your annuity contracts. If you have one issued by AXA, it's called the accumulator variable annuity between 2004 and 2009, they're wanting to try to buy those back because actually they're a decent deal. Okay, thank you. So here's what I would suggest people do. On this show today, we're going to talk a lot about income riders. If you have a current annuity, thinking about an annuity, go to TonyWalkerFinancial.com. Contact me immediately before you purchase any annuity or do anything with any present annuity. If you're outside the Southern Kentucky area, you can go down to Find an Advisor. In fact, we're going to meet one of our advisors down in Florida shortly. So again, go to TonyWalkerFinancial.com. And John, when we come back, I'm going to talk about how annuities and insurance companies can guarantee as high as a 7% rate of return and how they do that.
All right, we're the Worry-Free Retirement, the only show dedicated to helping savers like you worry less about their money. We'll be right back.
How would you like to find a trusted advisor in your area who practices and preaches the same safe money solutions that I speak of on this program? Well, you can by simply logging on to TonyWalkerFinancial.com and clicking on the Find an Advisor link. Once there, just fill out the confidential profile and submit it. This free service is available to savers who are serious about safeguarding their money. So what are you waiting for? Stop worrying and log on to TonyWalkerFinancial.com.
And now it's time for Tony in the Trenches.
Hey Tony, I have an annuity with an income rider on it, and I was thinking about taking out some distributions. How will that affect if something happens to me? How would I handle that?
I think that's a question a lot of us have.
Yeah, Income riders, I want to really get into those. It's really important to understand that these income riders provide very, very high guarantees, John, as we talked about in that last segment. How can these insurance companies, which issue annuities, how can they promise these very high guarantees? So what I'm going to do, I'm going to go over to the whiteboard. This is probably going to take the entire segment. But folks, if you have an annuity, if you're thinking about buying an annuity, annuities are great tools. They provide what I call mailbox money. You're going to want to watch this because it's very important to understand what the insurance companies are doing with your money. Let's come over here, and basically there are 3 types of accounts within the annuity that they're going to track. Back several months ago, a large insurance company asked me to speak to many of their advisors at one of their conferences, and they said, Tony, we know you do a lot of work in this area. Could you help our advisors who sometimes, quite frankly, have difficulty understanding all these options, come up with a simple way to help explain these options, especially the income rider and how they work, to their clients and prospective clients, which I did. So I created this one-page form for the conference, and what's funny is I've now started using this page for lots of things, and other advisors are using it as well, and I think it's going to help. So as we go to the whiteboard here, here's what I'm going to do. I'm going to imagine that we put in $100,000 into what's called an indexed annuity, okay? This is, now again, an income rider we're talking about can be added to a variable annuity. It can be added to a fixed annuity and an income indexed annuity. I like the income annuities that are attached to indexed annuities, which are more geared towards savers. Remember, the variable annuities, again, are affected by the stock market. We don't really recommend the stock market. The variable annuities can have high fees. Those are more for investors. The index annuities are more for savers. So let's look at this. Now, in this example, an insurance company, we won't name any names here. There's a bunch of them that'll do this. In fact, to get your money, they're willing to even add a $10,000 bonus, or 10% of the premium you put in. Another thing to remember about annuities, this money you invest in the insurance company really is, let's call it what it is, it's really a premium. And this is something I cover in my workshops. What a lot of people forget is anything issued by an insurance company, although technically I guess you could call it an investment, you give the insurance company a premium. Now let me quiz you on something here. When you think about any kind of insurance product, whether it's car, home, health, life, okay, medical, it doesn't matter, you give money or you give premiums to an insurance company in exchange for what? Risk you cannot handle yourself. Obviously, if you gave money for an insurance premium for a car, you're worried that if you go out and have $1 million claim, somebody's there to cover it. With annuities, really the main factor of the annuity, especially the fixed annuity, is protection of principal. That's one of the guarantees you're given the premium for. The second is providing a guaranteed income you can never outlive. I like to refer to it as mailbox money. So let's look at how the income rider works, okay? In this example, because they're going to add an income rider on, in this example it's paying 6.5%, they can be as high as 7%. So already you look at that and say, whoa, wait a minute, a guaranteed income rider at 6.5%, there's got to be a catch. Well, it's not really a catch, but you got to understand the contract. It's not like making 6.5% at the bank, so hang with me. This is why, John, by the way, we may be covering this into the second segment. This is the type of stuff I'm going to go through pretty quickly, folks, but at workshops or in our booklets or videos that we provide, we can go in this in more detail. But again, watch what we're doing here. So it makes 6.5%, and notice there is a fee charged every year of 0.6 on this for the income rider. Because the insurance company has more exposure, because they're providing a higher rate, they're going to charge a fee. Now again, a fixed index annuity, that's not bad compared to a variable annuity fee with the income riders, management fees, etc. is about 3.5%. That's why savers don't like variable annuities. So let's look at the 3 types of values you can have. You can have a surrender value. Now again, John, I would ask you this. If an insurance company, you're going to give them $100,000, okay, and you're going to have a $10,000 bonus added, do you think you're just going to be able to walk in there the next day and yank out all that money?
No.
Okay. Well, they got to pay the insurance agents a commission, which is fine. They got to set up reserves. And in this example, at the end of year 1, if you had to surrender it, you're only going to get back $89,000. So you might ask, well, wait a minute, Tony, what in the world happened to my 6.5%, right? It didn't really exist. That's the point. We're going to show you how this 6.5% comes into play. So yeah, if you had to surrender it, that's a pretty big deal. So you don't want to take out one of these products if in fact you're thinking, I might need the money in short order. These are long-term retirement planning products. All right, let's go over to the second value that is listed within the contract, and it's called the contract value, and this is what's indexed to the stock market, but it does not have any risk. So what happens is if the market goes up, you get a portion. We've talked about indexed annuities on this show before. So let's just say for the heck of it, let's imagine we're showing this going up at 3%. All right, this is the index side. So at the end of that year, you would have $113,000. So John, that's not quite as bad, is it, right?
No.
So, and you got the bonus, and if you were to die, this is what goes to your heirs. So they'd get $113,000. Not bad, especially when you consider that's pretty safe.
Sure.
You with me? Okay, not bad. Now let's get over to what I call the income side. All right, and it's important to note that this is what's guaranteed to grow every year at 6.5%. We may have to slide over just a little bit. I'll move over here just a tad. I want to stay focused in on this. Because this is guaranteed, you would actually have at the end of the first year $117,000. Now, what is this column really for? And this is where it gets confusing. Folks, let me tell you something. There are a lot of people out there that are selling these annuities now, whether it's through dinner seminars, mailers. A lot of people now, the big pitch is, let me look at your Social Security, and they do an analysis. Well, a lot of them are really wanting to talk about annuities. So be very, very careful here, because a lot of them are leading with this concept of I'll make you 6.5%, I'll make you 7% guaranteed. That's really a half-truth. That is true, but it's only effectuated if you use it for income. Let me show you how this works. So what happens is when somebody's ready for what I call mailbox money, okay, we'll put that here, what the insurance company is able to do is they're saying, oh, you want a guaranteed income you can't outlive? What we'll do, we'll take this amount and we'll multiply it by what's called a payout rate. Now, if you were to take income, I've done the calculation in this example, that would pay you, and John, I'm sure you wouldn't think this is too bad. What they're saying is, if you decide to elect mailbox money, we'll take 5% of this value, and we would pay you $5,272 a year, guaranteed for the rest of your life. How's that sound?
That sounds pretty nice. I like the sound of mailbox money.
Okay. So again, yeah, so what we're saying is this income rider, all right, it's very important to understand. We're going to come back in the next segment here and share with you how these three columns work. But the income rider is a real number. But for those of you who are numbers people, or maybe you're in the accounting profession, just think of it as an accounting feature of the product. It is not a number that can ever be liquidated. All right, so I see people coming to me and they've met with advisors and they say, hey, I've been told I can get 6.5%, it's guaranteed, I can walk away with the money at some point down the road. That is not true. You can't walk away with any of this amount. This amount is used to calculate mailbox money. So if the person comes in after the first year and gets mailbox money, it's $5,200. Now let's imagine this, John. Let's slide back over here. Let's say they waited 5 years, never touched the annuity. So the surrender value is starting to go up, so that's looking a little better. So if they were to surrender the contract after 5 years, they'd get 94, closer to what they had. Let's say the contract value kept going up at 3%, so they'd have $127,520. So in this case, if they were to die, their heirs would get that amount. But now, the income account, because it's growing at 6.5%, that's getting a pretty big number, isn't it, John? 150 grand. Okay, and this is guaranteed. How do you get that money, though, John?
Well, you have to wait. You can't ask for it immediately. You have to wait till you retire there.
That's right.
Mailbox money.
You have to elect income, which it goes up because you're getting older, 75, 35 a year. Right. So folks, when we come back, I'm not finished with this illustration. Hopefully you're seeing all the moving parts of an indexed annuity with an income rider, and I'm going to explain also why these variable annuity companies are wanting to get out of these contracts and buy them out, because they lock themselves into rates that they can't continue to support. So when I come back, you're watching the Worry-Free Retirement. I'll go over indexed annuities in more detail and income riders, and we're going to talk to one of our reps down in Florida. It's going to be a good segment. Stay tuned.
Yes, indeed. And this is the Worry-Free Retirement, the only show dedicated to helping savers like you worry less about their money. We'll be right back.
For nearly 30 years, I've made it my life's work to help savers worry less about money. And now I invite you to personally contact me to discuss your situation to see if I can help you. It's very easy. You just log on to TonyWalkerFinancial.com and click on the Meet with Tony link. Or, if you like, you can attend one of my free financial workshops. As always, there's never any cost or obligation to meet and discuss your situation in private. So what are you waiting for? Log on to TonyWalkerFinancial.com.
Welcome back to the Worry-Free Retirement. If you're tired of the stock market roller coaster, if you don't want to spend your days analyzing stocks, if you're a saver, this is what the show is all about. The Worry-Free Retirement, helping savers like you worry less about their money. All right, Mr. Walker, we were talking about this annuity buyout, and you hooked me in here. If you could, explain a little bit more on this. This is informative. Good stuff.
You mentioned something before I jump back into this. It's kind of interesting. If you're tired of worrying about the stock market, what I've found with the Worry-Free Retirement, where it's different, John, is people are getting tired of worrying about their money, especially savers. You know, I tell the story, folks, about my granddad all the time, but it really is true. I got to watch his life play out. My parents divorced at a young age. I spent a lot of time with my granddad. He worked for the same company for 43 years. He retired in 1978 with what he called mailbox money. He had two very important checks that lasted the rest of his life, guaranteed: his pension and his Social Security check. The man never owned a stock, okay? Never owned a stock. And by the way, John, let me share something with folks. We can go to the Elmo here. I'm dancing around, I'm sorry. That wasn't bad though, was it?
No, it wasn't bad.
I almost did the moonwalk on that. If we can actually show the Elmo here, I wanted to call this up. Let's look at, this is what's wild, okay? This was a variable annuity. Let's take a look at this. Let me zoom in. Now, John, this was a particular variable annuity. I want you to look, the total payments since this person took it out, this was taken out in 05. Are you seeing that? 2 years before the stock market crash. See, 2005. All annuities have a contract. It's always important to know the contract date. They put in $25,000. They've only withdrawn $5,000 since then. Do you see that?
Right.
Okay. What's interesting, the death benefit is 19, surrender value 16, contract value 15. See those same values? Now look at that. Guaranteed minimum withdrawal protection benefits 23. See all these different numbers. The average consumer looks at that and says, what in the heck? The point is, though, with a variable annuity, this is why savers don't like it. Put in 25, you've only taken out 5. That's been, what, since 8 years? And it's only worth $16,000? You got to be kidding me.
That's
okay?
a losing proposition.
Yeah, and so that's why we say these index annuities are so much more feasible for savers.
Well, even the sound variable, to me, says risk. So stay away
Exactly.
from the variable annuities. They vary because they're really depending on the stock market.
That's right. Well, let me finish this illustration up, folks. Let's go back to the whiteboard here. I got the camera folks working today, doing a great job, by the way. Let's go to the whiteboard and kind of finish up this illustration because we've got our representative out of Florida on the line here. I want to talk to him via Skype, but let's go over this, kind of zoom out. Okay, John, quiz time. All these boxes I diagrammed during the break. I was busy little beaver here. We've got 3 columns, and this is what I designed in this workshop to help consumers understand. This column over here, what is the surrender value for? It's only if you cancel the contract. So if you were to cancel this contract, John, in the 5th year, in this example, you get 94. You with me? Mm-hmm. What's this column over here for, the contract value? It's for death benefit, or you can take out 10% minimum distributions from that every year. So if you died worth $127, that's what goes to your heirs. So what is the income account value worth? It's only used for income. Does that make sense?
Yes, sir.
So what we have here, folks, is you've got to have a process to analyze these annuities. You have a lot of moving parts. With the fixed indexed annuities, we specialize in these products. These are great products for savers. You can put 401ks, IRAs, your regular savings accounts, inheritances, all kinds of things can go in these products. And as you can see, these are not your granddad's annuity. These newer annuities are much more flexible and allow you to be in more control of your money. Now, I think if I can segue here, because we're really excited, as many of you know, we have stations around the country who show the Worry-Free Retirement Program, and what we decided to do is every show just take a few minutes and introduce to you advisors around the country who are following up with phone calls and information that you've requested. So I think on the line, hopefully we've got Bill Offbaum. Hey, Bill, what's going on?
Tony, it's great to be with you guys.
Oh, great. And you did figure out the Skype. I'm impressed.
Well, actually, I had my son do it for me.
Hey, Bill, real quickly, tell us where you're located out of. I know you even have a radio show, your years of experience, all that good stuff.
Yeah, Tony, I'm out located actually in South Florida. I have a radio show that plays on WJNO, News Talk, and Rush Radio in the Treasure Coast. So therefore, I have 3 different offices. My main office is in Palm Beach Gardens, and I have satellite offices in Vero Beach. and also in Fort Lauderdale in order to service our clients the best possible way. I appreciate being on here today. I've been watching your show for about 6 months now, and had tons of people calling in. They're calling in basically because my practice is the same as yours. It's a safe money practice. We look at principal preservation, number one, and income guarantees, number two.
All right, Bill, I'm sorry, we got to wrap it up, but you can check out Bill and get a hold of him. Just go to TonyWalkerFinancial.com and click on Find an Advisor. We'll be right back on the Worry-Free Retirement.
How would you like to find a trusted advisor in your area who practices and preaches the same safe money solutions that I speak of on this program? Well, you can by simply logging on to TonyWalkerFinancial.com and clicking on the Find an Advisor link. Once there, just fill out the confidential profile and submit it. This free service is available to savers who are serious about safeguarding their money. So what are you waiting for? Stop worrying and log on to TonyWalkerFinancial.com.
TonyWalkerFinancial.com. Click on Contact Tony, and the first 10 people to do so will receive all 3 of his books absolutely free. You got to leave your name, you got to leave your address, and leave some all your contact information, and Tony will send them all to you. Tony, those books are fabulous. You got the Worry-Free Retirement, Don't Follow the Herd, and the 3 Personalities of Money.
Absolutely. Over a $50 value, absolutely free. We look forward to hearing from you. Just go to TonyWalkerFinancial.com.
And we are the only show dedicated to helping savers worry less about their money. We'll see you next week right here on the Worry-Free Retirement.
You've been watching the Worry-Free Retirement with financial advisor Tony Walker. To ask Tony a question or to find an advisor in your area, log on to TonyWalkerFinancial.com.